Good morning, everyone in West Coast, and good afternoon, East Coast. Thank you for joining this session. As many of us know, there are a lot of type of business available to conduct the business, and many times client comes to us, and many times they ask us, what is the what entity I should form. So I'll try to explain the different type of entities available, and we can just go from there. Very first type of entity is called sole proprietorship, which is owned and operated by the one person. And it's a simplest form of business ownership. As far as the income taxes for the sole proprietor, owner pays the income tax on the net profit. And if there is a losses, then owner can use that losses to offset any other income he has. So that's how it works. In addition to paying the income tax on the net profit of the business, owner has to pay the self-employment tax, which is Social Security and Medicare tax. So the tax rate for Social Security and Medicare is 6.2 is a Social Security, and 1.45% tax is a Medicare tax. So that adds up to 7.65, which employee has to pay, and company or the business has to match, employer has to match. So that's how it becomes the 15.3, which is required to pay up to $137,000, the Social Security, and Medicare, there is no limit. If let's say business has a $500,000 profit, then Medicare tax applies to entire $500,000 profit. This sole proprietor business do get special 20% qualified business income deduction. And this is a very new deduction introduced as part of the major tax reform US had in December 2017. So this qualified business income deduction is newly introduced as part of the major US tax reform in December 2017. So it's fairly new. And the reason this got introduced is mainly because the corporate tax return, the corporate taxes, which many big corporation has to pay and small corporations to pay, used to be highest rate used to be at 35%, and that 35% rate they reduced to 21%. So there was almost 14% reduction in the corporate rate. So to give that equivalent benefit to other form of business, they have introduced to this qualified business income deduction. So let's say for sole proprietor business has $100,000 net income, you report $100,000 income, you get $20,000 deduction, and ultimately you're gonna pay tax only on net $80,000 profit. So basically, you are paying tax only on $80,000. The biggest disadvantage of sole proprietorship is unlimited liability. So let's say, sole proprietor conduct any business, and if something goes wrong and it got some a customer or some other party files a lawsuit, then there is no limited liability. Pretty much he's exposed to all personal assets, which is a very big disadvantage. The second form of business is called partnership, and the partnership has a minimum 2 partners. That's why it's called partnership. One person cannot have a partnership, so minimum you need the two person. And as far as the upper limit, there is no upper limit. It could be 1,000, 2,000, 5,000 partners, and that is real example of that is all the big real estate investments is a partnership, limited partnership, where hundreds of thousands of partners are the partners. There are 2 types of partnership. One is called general partners, and other one is called limited partners. So the general partnership is pretty much all partners are liable for any activity of the partnership. So there is unlimited liability to those general partners. So if any legal action or any other lawsuits filed against the partnership, then not only like assets of the partnership get attached, but individual partners also get responsible for that. Whereas the limited partnership, the way it works is limited partners do not have a unlimited liability. They have a the only liability they have is the amount of investment they have put it into the partnership. But in order to have a treatment of limited partnership, there has to be minimum one general partner. And that one general partner is basically liable for all the activities of the partnership. Partnership entity do not pay the tax because the partners has to pay the tax. So it's called like a flow through or pass-through treatment. So you use this term like flow through or pass-through, which means any profit made by partnership do not pay the tax. It just give it to the partners to take care of the taxes. Any profit partnership has, so all the active partners in the partnership are required to pay the self-employment tax, which is again the Social Security and Medicare tax, which is again 15.3%. If the partners are not actively involved into the business, then they don't need to pay the Social Security tax, but still they have to pay the income tax. Partnership profit is also qualified for the qualified business income deduction, which is the new deduction in part of the major tax reform we had. Partnership, the partners cannot take the payroll, like they cannot like run the payroll and take a W-2 from partnership. Instead, partnership can give them a guaranteed payments. So guaranteed payment is just, let's say if partnership decides to give $5,000 a guaranteed payment to partners. So partnership write a check for $5,000. There is no tax withholding, no Social Security, no any other income tax withholding is done. 5,000 just give it to partners deposit in his account, and partners has to report the that 5,000 as a guaranteed payment income, on which he has to pay income taxes and he has to pay the self-employment tax. In partnership entities, foreign partners are allowed, so there is no restriction. So if any person lives in foreign country would like to become a partner, he or she can do that. But if foreign partner is a partner in partnership, US partnership, then partnership required to withhold the income taxes because, as I mentioned earlier, partnership do not pay the tax, partner pay the tax. So let's see if there is a ABC partnership and a partner A and partner B are US resident and partner C is a foreign resident. So the profit partnership makes, A and B pay the taxes here in US. So US just want to make sure how we can collect the taxes from partner C who is sitting in foreign country. So US does not have a jurisdiction over foreign countries resident to tax. So they just want, IRS wants to make sure partnership withhold the taxes before it distribute the profit to foreign partners. So even though the foreign partners do not file the tax return, US government collect the taxes. There is a requirement to file the taxes by those foreign partners because the partnership is not paying the taxes. And here again, the disadvantages are unlimited liability to all general partners. And you do hear about other type of partnership like LP, which is a limited partners. There are another form called LLP, like limited liability partners. So all of them are pretty much have the same tax treatment, and limited partners are protected in terms of the unlimited liability, and they are not required to pay the self-employment tax. Any questions so far? Okay, so then we'll just.
I have a question regarding QBI.
Okay.
Regarding QBI, eligible 20% QBI deduction, is it only working for the profit, or what about loss? Is it deductible or not?
No, when you have a loss, then you claim the loss, full losses you are claiming, right? So like 100% you are claiming. So there is no deduction on the loss. So the maximum you can claim is the loss. There is no additional 20% on top of losses.
Okay, thank you. I got it.
Hey, Ramesh, quick question. That net profit that you're talking about that is accumulated, is that paid quarterly, monthly, annually? How do you pay that?
I mean, it's up to the partnership agreement, whatever partnership has agreed, all partners have agreed. It could be monthly, quarterly, semi-annually, or even annually. So it's all up to. Yeah.
To clarify, what I mean against that, the 15%, it's on the prior slide, that's owed, the employment insurance, is that paid per the agreement, or is that per IRS rules?
Oh, okay. So this 15.3 you pay along with your tax return. So once a year only, when you file an income tax, individual partners pay the taxes at that time.
Got it. Thank you.
Yeah, but then individual partner, if the threshold is more to pay the estimated taxes, then they have to pay quarterly.
Understood.
Advanced taxes. The another form of the entity is called corporation. Many times we call it a C corporation or regular corporation to differentiate between C and S corporation, which I'm going to discuss later on. So a corporation is it's an artificial person created by the state law. And the biggest advantage this form of business offer is a limited liability. So shareholder, whatever investment he or she has put into the company, that's what basically is liable. There is no risk of personal assets to the business activity. In terms of the US business, 19% of all businesses are corporation, but the revenue collected by or revenue generated by those 19% businesses are almost 82% of the total sales. So you can see how widely used this form of the business in the country, and the biggest reason is the limited liability. In terms of the number of shareholders, there is no limit. So just give an example, like the Apple and Google, they are the corporation, like a C corporation, and they have millions of shareholders. There is no limit in terms of the number of shareholders they can have. It can have. And as far as the type of stock, C corporation can issue called common stock and preferred stock. And even common has a few type of stock, the different type of common stock with rights, without rights, and the preferred stock is another type of stock company can issue. And the reason it's called preferred because it has some preference over common shareholder. So one of the preferences many time this preferred share has a dividend attached to that. Plus, when you wind down the business, preferred shareholder has a priority in terms of the distribution of assets. So let's say if when we wind down the company and there is $100,000 left, and the total money we have to distribute, first we have to distribute the preferred shareholder, and anything left over we distribute to the common shareholder. In terms of the disadvantage from the tax perspective is that it is subject to double taxation. So what I mean by that is first level tax company has to pay on its profit, and the second level tax on the dividend received by the shareholder. So just give an example, if the Google makes $10 billion of profit, normally around 30% tax Google had to pay. So after paying 3 billion in taxes, that's 7 billion. If Google decides to distribute as a dividend to shareholder, each and every shareholder who receives the dividend, they have to pay the tax on that dividend. So this basically the $70 get taxed twice, one at the Google level and second at the individual shareholder level. The good thing about this, this US tax reform we had in 2017, they lowered the tax rate from 35 to 21%. So the impact of this double taxation is really gone down substantially. The 20% qualified business income deduction, which I talked about, available for partnership and for the sole proprietor, not eligible for a corporation, and the reason being their tax already reduced from 35% to 21%. So that is the reason. Corporation, C corporation can have the foreign shareholder, and if the corporation has a foreign shareholder, they are not required to file a US tax return. So when I said earlier, like if foreign partner is a partner in a partnership, foreign partner is required to file a tax return, which is not the case here. So like Mr. A sitting in foreign country owns 100 Google share, is not required to file a tax return here in US. But when US company or the corporation issue the dividend to foreign shareholder, so then there is a 30% tax withholding. And this 30% tax can be lower if US has a tax treaty with the foreign country. So just give an example, like we have many clients in India, and so this India folks receive the dividend from any of our US client, C Corp client, then their tax withholding rate is a 15%. Because there is a special treatment agreement between India and US, which allows a lower tax rate. Many times, like the businesses are looking for a sale of the assets or the reorg, like the mergers and acquisition or sale transaction. So corporation can sell the assets, but when corporation sell the asset, it triggers the double level tax. What I mean by that is, like when companies or the C Corp sell the assets first, whatever gain we have on the sale of assets, company pay the tax, and whatever left after paying tax, if company decides to issue the dividend to a shareholder, then there is a second level tax. But many a times, like if company has a net operating losses carry over, then you can consider like selling the assets, because the gain you have on the sale of asset, you can offset with the losses carry forward from the prior year. As far as the exit perspective, like there are few planning opportunities are available specifically for the C corporation. So C corporation is the only type of entity which allows the capital gain exclusion for the qualified business stock. So there are the rules which can qualify the stock as a qualified small business stock under section 1202. And if you meet those requirements, then gain on those sale of the assets up to 10 times of the stock basis or 10 million, whichever is the greater, you don't have to pay the tax. So just give an example. If Mr. A started a company and invested $100,000, and after 10 years, he sells the stock, so his investment is $100,000, 10 times of that basis is $1 million. So he can exclude 1 million or 10 million, whichever is greater. So in this case, it's a $10 million. So Mr. A can exclude entire gain on the sale of $10 million. There is another opportunity available, is called rollover of gain. You can roll over the gain full or partial under section 1045. Which is, again, the stock has to be qualified small business stock. If the shareholder has held the stock for 6 months, and immediately after the sale, within 60 days, you have reinvested that money into another corporation stock. So this is another advantage. So many times, like if business owners sell the business, and if they would like to start another business venture, they can consider taking the advantage of that. So just take the profit take the gains from the sale of the stock, start another company, invest into that, and you can get the gain exclusion on that. Another advantage that like at times, like the people do have losses. Whatever they plan, it's not become successful, so they may have losses. So usually the loss on the capital stock is a capital loss, and capital loss you can claim $3,000 a year. That's the limit any person can claim. So if someone has invested $100,000 in one business and ran that business for 2 years, and it's not a successful venture, and he decided to close down. So in a normal scenario, for him it takes years to take $3,000 deduction. Like many years it takes to claim the $3,000 deduction over many years. So instead, you can apply this rule, and you can claim entire $100,000 as ordinary loss in 1 year. You can offset with any other income you have. So 100,000 is for the joint filer, like a husband, like spouse, both spouse. But if the shareholder is the single filer, then he or she can do $50,000 ordinary loss rather than $3,000 a year. So many times, like if like especially the exit transaction or the merger and sale transaction, seller always look for the sale of the stock because he or she has to just pay the tax only on the sale of the stock. There is no double tax. So they prefer sale of stock, whereas the buyer on the other side prefer the purchase of the assets because if they purchase assets, then they can write off those assets in the next 15 years. So to do like the compromise for both the side, there is a section 338 election is available. What it does is, even though seller is selling the stock, but it can get the treatment of the asset sale, which is the preferable option by the buyer. Any question on the C corp?
Yeah, Ramesh, just like this two different amount, 50,000 and 100,000 for single filer and joint. So how about that 3,000? Is it flat amount, or like it is 1,500 and 3,000, the other limit?
Yes, so that's always a 3,000 for single and joint filer. 3,000.
Yeah. So 3,000 per return. Okay.
Yeah. And by the way, like it's so surprising, like that 3,000 limit is still there since 1982 or something, So there is no inflation adjustment done in last almost 40 years.
Okay.
Any other question?
So we are talking here about small business benefits. So what really qualifies as a small business?
Yeah, so there are like few requirement. One of the requirement is stock needs to be held for 5 years. So you start a company today, and you cannot take the advantage of this after you sell the stock after 2 years. You got to hold for stock for 5 years. Stock needs to be originally issued by the company, which means like if Mr. A acquired the stock from company A and Mr. A sell the stock to Mr. B. So basically, Mr. B is not acquiring directly from the shareholder, from the corporation. So Mr. B stock acquisition may not qualify. Another thing is that stock needs to be issued after August 18, 1993. The turnover of this small business has to be less than 50 million. And I believe the total assets of the company is $10 million or something. That's what I recall. But those are the main criteria. And the business under which this company has to be active business. What I mean by that, like corporation cannot have the passive business like real estate or any other passive investment. It has to be a operating business where like business is employing employees or having a wholesale or manufacturing. So it's like active operating business.
Got it. Thank you.
Any other question?
Hi, Ramesh. How are you?
Good. How are you?
Good, thank you. This is just a question on the structure for corporations. Like I tend to see that normally there's a board of directors, a CEO, operating officers, and whatnot. So when you issue the stock, do you have to issue stock so that there's no majority of control, or you should seek for a majority of control of the company? Like for instance, could you issue a 50% ownership for, let's say, two people in a corporation, or would you do like a 51% versus 49% where a majority would have more power on the corporation? What's the idea on that?
Yeah, so the stock ownership is something like the client decide if there is a possibility you can have the 50-50 ownership. But if they are concerned about like one person would like to have a majority, another person, then you can do 51-49. But yeah, 50% is a possibility. You can have any combination. But if one person is concerned about majority and voting and all, then 51-49 is recommended.
Oh, okay, that clarifies the question.
Any other question?
Hi, Ramesh. This is Jagan from Virginia. For the C corporation shareholding pattern, where it's a startup, let's say with two shareholders, one is a citizen and let's say other is, for example, a Canadian. The Canadian is allowed to hold 50% or less shares in the corporation.
There is no limit how much foreign person can own. It can own 99%, it can own 1%, it can own 50%. So there is no restriction. There is no restriction. Anybody can own any number of percentage of the stock.
And any disbursement from the corporation to him, he doesn't have to file any US return. The foreign person.
Yes, as long as the US corporation do not issue the dividend, there is no tax reporting or no need to file the tax return. But even like if corporation issue the dividend and if a corporation does the withholding of the taxes, then foreign shareholder does not even need to file the tax return.
So it can be like a 1099?
Company can issue the 1099 dividend. So there is a form at the end of the year company needs to issue that notifying to IRS that I have issued the dividend to my shareholders. So that 1099 dividend is getting issued. But in the case of the foreign shareholder, like not having a social security number, I don't know how still required to file, but there is no social security number. And because of that, like IRS wants to make sure company withhold the taxes. So if tomorrow if foreign shareholder do not file the US tax return, they are still getting the taxes.
Yeah, Ramesh, Shailesh here, just to add on that point, in Jagan's transaction, for example, Canadian person is 40% and company issues for to file the tax return to claim the refund. So the Canadian person approach US consulate in Canada, or like there are like a lot of acceptance agent, and he can apply tax ID number while being in Canada, and then can use the same tax ID number on the 1099 DIV and to file the 1040 return. So he can go tax ID route through acceptance agent.
Correct. Next type of corporation is called S corporation. So the S corporation, the criteria for being a S corporation is it cannot have more than 100 shareholders. So the maximum shareholder is 100, cannot have more than 100 shareholders. And the type of shareholder which could be the allowed members or the shareholders are individuals, estates, and trust, which means C corporation cannot be a shareholder into S corporation. Partnership cannot be a shareholder into S corporation. The only thing is available is if one S corporation own 100% of another S corporation, then it is allowed like S corp to S corp. So basically, the parent and subsidiary both are S corporation, and the ownership has to be 100%. And the type of stock it can issue is only one type of stock, and usually is a common stock. It cannot issue the preferred stock, and because of this limitation, it cannot issue the preferred stock. All these VCs and angel investors, they really look for that preferred stock. So this S corporation is not a preferred form of entity for VCs and investors. And yes, I mentioned like no partnership or S corporation can be a shareholder. Also, for a non-resident person or the foreign entity cannot be a shareholder. So many times we do like get a query where like the one person is US based and it could be like the 50-60% of the shareholder of S corporation, and then they say, okay, I have another person who would like to join as a shareholder, and I would like to have a single level tax treatment, and I'd prefer to have S corporation. Can I have my other partner being in foreign country be a shareholder of S corporation? And the answer is no. So foreigner cannot be a shareholder in S corporation. And many times what happens, if it is an ongoing S corporation and is in the business for many years, and let's say by whatever requirement, if you add the foreign person into the company, into the S corporation as a shareholder, the moment you add the foreign shareholder to the S corporation, it loses its S corporation status by operation of law. So there is no election, there is no form or anything. It's just like automatic revocation of the S corporation status. You lose S corporation status and it just becomes the C corporation day after. It's automatic treatment. In terms of the tax treatment for S corporation is a flow through, which means company do not pay the tax, S corporation do not pay the tax, all shareholder pay the tax. And there is no double tax because shareholder is paying the tax. The benefit of limited liability, so it provides the same protection which C corporation or the regular corporation provide. The net income of the S corporation is also eligible for the 20% qualified business income deduction because company do not pay tax, shareholder pay the tax, and for shareholder to get the benefit of lower tax from 35% to 21% for regular corporation, they are giving the 20% business income deduction. So this profit company has, shareholder do not need to pay the self-employment tax, which is the requirement for the partnership. So if partner is actively involved in the partnership and receive the K1, the net profit K1 with $200,000 income, entire $200,000 income is subject to self-employment tax, which is not the case here. So let's see if the shareholder is actively involved in the business, he can take the payroll, which is like a reasonable payroll for the services he provide to S corp, and any profit remaining which he received from the company is not subject to self-employment tax. So which is a very good thing we need to keep in mind because this difference is we can compare with the LLC, which I'm going to discuss later on. So the biggest advantage between LLC and S corp net income is not subject to self-employment tax as long as the owner or the shareholder has taken the reasonable salary. And this is ideal for owners who are looking for the exit or the sale of the business. So if any of our client is looking for an exit in the next few years, then we should consider making the S corp election, because for S corporation, if shareholders sell the stock or S corporation sell the assets, there is a one level tax. So it's really not make any difference for S corporation owner either to sell the stock or the asset. And because it's S corporation, it can make the Section 338 H10 election. What it does is even though shareholder is selling the stock, for buyer, it would be treated as a purchase of the assets, which is always most buyer is looking to get the asset purchase treatment, because many times, like they are paying the goodwill or the some intangible assets, and that's why they are acquiring the business. So whatever amount they pay for the goodwill or intangible assets, IP or trademark or any other intangible assets, buyer can deduct in 15 years. So let's say a buyer pays $15 million to acquire assets of this company, S corporation. Per year, they can write off $1 million as a deduction. And over a 15-year period, they can get the entire deduction of $50 million, which is the purchase price, which cannot be done if you acquire the stock of the company, because when you acquire the stock of company, you basically just hold the stock, and when you sell eventually the stock, at that time you can use that as a basis. But while you are owning the business, you are not getting any deduction. The one thing, this S corporation is not offering good advantages is this gain exclusion, which is available to C Corp. So this 1202 gain exclusion or 1045 rollover of gain from the sale of stock, or the ordinary loss 50,000 or 100,000 for joint filer. None of these three provision is applicable to S Corp. So yes, it has a single level tax and all, but this is not the advantage available to S corporation when you are having an exit. So the next type of entity is called limited liability companies, LLC. So limited liability company, for the tax purpose, by default, it is getting the partnership treatment if there are two or more members in the LLC, and if they do not want to get a partnership treatment, then they can elect, and there is a form you have to file with the IRS, informing IRS that we would like to have a corporation treatment, not as a partnership treatment. Many a time, like one owner own the LLC, which is many states allow that one person can own the LLC. So it's called like a single member LLC. But if that is the case, then it's not, it's called like a disregarded entity. So it's not separate from its owner. So what I mean by that, so let's say if I start a LLC and I'm the only member, so yes, I do have a legal protection, but when I file the tax return, I have to file a Schedule C on my individual tax return and report the operation of the LLC. Similarly, let's see if ABC company owns LLC. So LLC do not file a separate return. ABC corporation, when it file its own tax return, they have to report the operation of LLC as part of the ABC Inc. and combine both the business operation and report on the corporation return. You can make the S corp election. So even though for legal purpose you are LLC, but you can convert that LLC. First, you have to make the election to be taxed as a C corporation or the regular corporation, and once it is a corporation, then you can make the S corp election. And so people may ask why you want to do this, because LLC provide the single a one level tax, so does S corp. But as I mentioned earlier, to avoid to save the self-employment tax, this is one of the technique you can use. Convert the S corp election, have a reasonable payroll, and remaining K1 profit is not subject to self-employment tax. The advantage of LLC is avoid the double taxation if you elect the partnership treatment, and it offer the limited liability. Many states do not allow a professional, for example, like a physician, CPA, attorneys, to be a LLC because, if imagine the doctors having LLC and surgeon is making any mistake on the surgery, it cannot protect by having LLC. So there is a limitation. And many times I have, even like a few months back, I have seen like two, both of them are practicing attorney, and they just form a LLC in California to conduct their business under LLC. Then when I saw that, then I guide them like you cannot have LLC or to be a corporation, and you can take the S corp election to get the single level tax treatment. LLC are not restricted to 100 shareholders like S corp. So LLC can have unlimited number of partners or the members. LLC also eligible for a 20% qualified business income deduction, and the profit LLC has is subject to 15.3 self-employment tax for the active members who are involved in the active business. And if LLC has a foreign members, which is allowed, but then the same withholding and tax filing requirement is there, which is the partnership has. So the owner of LLC is sitting in foreign country, that there is a withholding here in US. Then there is another type of entity which many of our international or the multinational client has. It's called US branch of the foreign corporation. So first, in order to have a branch here, we have to register the branch with the Secretary of State, similar to what we do with the forming a company or forming a LLC. So it is called like a branch, which means it's not a separate legal entity. Even though we are creating with the operation of law by registering with the Secretary of State, it does not have a legal separate identity from the head office. So head office in foreign country has a unlimited liability. So for example, if multinational company in UK start a branch here, and if there is a very big legal battle and there is a big judgment against the branch, so the defendant can go not only like an asset of the branch, but it can go to the head office in UK and try to get the settlement. They try to get the award from the head office. So basically, head office is liable, and because of this unlimited liability, we need to keep this particular exposure in mind when we advise to client, because many a time foreign clients, they do prefer to have a branch because it has some ease of operation. Another thing, like if branch loses the money, which is normally the case in the initial year, those losses they can use in the foreign country. Head office can use those losses and reduce their losses, reduce their taxes in foreign countries. So because of that reason, they prefer to have a branch, but they are not. They are not aware about this having unlimited liability exposure. As far as the tax, federal and state taxes, it's the same as C corporation. So there is no difference having a branch or a corporation, the same federal rate and state tax rates. When branch repatriate the profit to head office, then head office is required to pay the branch is required to pay the branch profit tax, which is the 30%, or it could be a lower tax treaty. So as I mentioned earlier, in the case of the corporation, for example, like Google pay the tax. After Google paying tax, if it issue the dividend to shareholder has to pay the tax. So here, first branch has to pay the tax. After paying tax, whatever left as the return earning, if branch remit that money to head office, then there is a similar withholding 30%. But if US and foreign country has a lower tax treaty, then it's a 15%. So in the case of India, we have a treaty, and instead of 30%, it's a 15% branch profit tax apply. With regard to corporate reorganization like the sale or merger, branches is not as friendly as a corporation. And we had one practical example, and we had very go through longer process, and that branch cannot merge with any other US entity. We have to basically dissolve and form or transfer the assets to another company. Single member LLC owned by foreign corporation is treated as a branch. So many times the foreign business owner would like to have a single level tax treatment. So they may consider let's have LLC, but when you have a single member LLC, so as I mentioned earlier, the single member LLC is not separate from its owner. So here, having a single member LLC by foreign company, basically it is an extension of the foreign corporation. So this literally we are creating a branch here, and all the branch rule apply to the single member LLC. Any question on the branch and other?
Yeah, Ramesh, for this single member LLC owned by foreign companies treated as the branch, so which tax form they file? Is there any separate form number other than 1120 for branch?
Yeah, so your branch, even though let's say if you don't have single member LLC, but if you just set up a branch here, so there is a form called 1120F. F is a foreign,
Okay, 1120F. Okay, got it.
Yeah. So branch file the 1120F, which is a foreign corporation tax return.
Okay.
Hi, Ramesh. This is Kapil. Yeah, great topic. So my question is for this foreign branch, when you are mentioning, Ramesh, it's all unlimited liability and then so much taxation. So still, if there is a market that it serves, or it's just a sheer bad advice that they get from their professionals, or there is a market that the foreign branch has to serve?
Yeah, so as I mentioned, many a time, if they are expecting losses in the initial year, then and they are paying higher taxes in foreign country. So if they have a branch losing money here, that losses they can use in the foreign country and reduce their taxes in foreign country. So in that scenario, it may make sense, but we need to look at the cost benefit, whether the benefit of that loss offset is against the liability exposure,
Okay, yeah, makes sense. And Ramesh, just going back to your earlier point of this qualified small business, just have a question. Is there any regulation similar to that in partnership, or it's all about C Corp and S Corp? Because a lot of times we have partnership entities and they have the similar, instead of stock, they have been issued all these units. But is there any regulation that gives them the benefit of this, units issued by the founding company or whatever, they are holding it more than 5 years and all that?
No. So yeah, so those 1202, like the small business stock and 1045 is not available to LLC. No.
Okay, and at what time they make the election, when they actually sell the stock?
Yes, there is no election. It's just basically if you meet the criteria of 5-year holding period and all those the original issue, all those 5, 6, 7 criteria, you can just automatically just report that. Just couple of weeks or last week, Khushbu had a similar client, and he sold a company, and it happens to be meeting those criteria, and he got a gain of $3 million. So he's not going to pay tax on entire $3 million capital gain he sold the stock for. So the next is many times we do get the where to incorporate the company. So that really something to do with the multi-state taxes. So the way it works is multi-tax. We have to see first whether business has a nexus in any particular state. So the nexus any business can create by having an office, employee, warehouse, factory. So the moment you have any of this, you are creating a nexus in that particular state, and business is required to file the tax return in that state. And So when if business is doing business in more than like the one state, like multi-state, then how do you divide or how do you allocate the profit between various states and pay the taxes? So the way it works is you have to look at you have to take the federal taxable income. So let's say if there is a federal taxable income of $100,000, that you divide between number of states you are having the business by using the average of three factors. So you have to look at the sales, payroll, and property and rent. So it depends on your sales, payroll, and property and rent in various states. You divide, so that's the average you get, and you use that average and allocate that federal taxable income and pay the tax in various states. Lately, like the many state has changed from three factor to only one factor, which is the sales factor. So that's a trend right now. It's like many states is collecting the taxes based only on the sales factor. So many times, like business owners are looking for like the Delaware or Nevada or any other state to incorporate there, but those will not be helpful if the average of three factor in that state is not major major factor in those states. So let's say even though you set up a company in Nevada, but if you don't do any business, if you don't have customer payroll or property or rent, then having a Nevada corporation from tax perspective is really no useful, because if all these factors are having in California, basically you are subject to California taxes. So you need to look at where ultimately they cannot do the business, and that's the state you should incorporate, or maybe you can incorporate in Nevada and Delaware, but you are required to qualify here in the California or any other state you do the business. One thing we need to keep in mind when we do set up a Delaware corporation is it has a franchise taxes, which is in addition to the corporate income tax. Though the corporate income taxes are lower, but this franchise income tax is based on the number of authorized share. And if you keep a higher authorized share, then company is required to pay the higher franchise tax. So please keep in mind, keep those in mind. For the foreign clients and having some sort of like a e-commerce type of a business, then Nevada could be a better option, because Nevada does not have a franchise income taxes and no corporate income taxes. The last yeah, so as I briefly mentioned earlier, for angel or VC investor, LLC is not a desirable. S corporation not desirable also, because it can have only one class of stock. It cannot have a preferred stock. So the C corp is the most preferable for the VC and the angel investor. With regard to stock option plan, LLC is possible, but it's not providing any tax advantage for the ISO. So S corp and C corp both can have the stock option plan, but it works very well with the C corporation. Net operating loss is something you need to keep in mind. So when you set up a company or entity for the client, ask whether are you expecting any losses initial year. If that is the case, then I think you need to consider LLC or the S corporation, because initial year losses, owners or partners can use that losses to offset their other income they have. Another thing is the California state. This is for California state. LLC has a $800 minimum fee, minimum tax. On top of that, there is a gross receipt fee. So if the gross receipt is $250,000 to $500,000, then $900. Up to million is at $2,500. Million to $5 million is $6,000. Over and above $5 million receipt, there is a fees of $11,790 plus $800. So if a business having a $6 million gross revenue and $1 million loss, still company is required to pay $11,790 and $800, which is quite a high fee. So you need to look for that. whether is LLC is better or the S corp better. As far as the S corporation is required to pay 800 or 1.5% of the net income, whichever is higher. That's the tax in California. And for the C corp is 800 or 8.84, whichever is higher, is required to pay the tax in California.